why you're seeing Bank of Uganda coming up and saying, anything beyond 1 million, we need to know who is actually engaging in this transaction, because it could be money laundering, it could be money for financing of terrorism, it could be money for things that are going to actually affect the economy. So that's why Bank of Uganda is coming up with that. And of course, with our financial stability department, Bank of Uganda is basically speaking to our mission, which talks about really stability and, of course, a sound financial system. So the Financial Stability Department, once again, we are grateful to you because they generate reports on a quarterly basis, and then they make sure that these reports reach out to the public domain so that actually the public knows what is happening. But we start with our key and valued stakeholders, and that's why we invited you here today, so that actually we can tell you what happened in the financial sector, especially for the quarter ending March 2024. You've heard me introducing Don Kalema from the Economic Research Department. Those are the architects of monetary policy. They do so many things, including modeling, and Don is here to answer anything probably relating to monetary policy, relating to the CBR, central bank rate, and anything inflation, and anything related to that. And of course, Team Economic Research is very committed to keeping the inflation within the target range. So as much as possible, that is something that they put a lot of emphasis on. So in case there is something concerning economic research, concerning monetary policy, please, you'll have the opportunity to ask. But our very own presenter, who is going to make a presentation, is well experienced in matters of supervision, and he superintends 3 departments, as you later get to know. That is commercial banking department, and I'm glad Huntington is already here. And the reason why I reintroduced Huntington, because those of us who are from the commercial banking side know how important Huntington is to us, and what he does to make sure that the banks stay really sound, and also protect the depositors, who are very key in this country. So TT is going to really deliver a very powerful presentation today, and we all look forward to it. But of course, I introduced Rosette. She stepped out shortly because Andrew superintends what we call the Financial Consumer Empowerment Mechanism, and I'm sure the SFIs know about this. We've had a working relationship with the SFIs, supervising the financial institutions, just to make sure that we empower the financial consumer. And because Bank of Uganda is very much committed to protecting the depositors and making sure that depositors' confidence in the sector is there as much as possible. That's why anything concerning the depositors, Bank of Uganda comes running very, very fast, because we want to protect but also empower that financial consumer. And that financial consumer desk basically currently is handling 2 things. One, which is information inquiries, and then 2, the complaints handling. Complaints are inevitable, especially when financial institutions supervised, licensed, and regulated by Bank of Uganda are dealing with customers. And it could be a sign of level of confidence and satisfaction by the financial consumer in the supervised financial institution. So I thought I could talk about that as well. And of course, one of the things communications does, I talked about it earlier, and communications has been very key in partnering with Financial Stability Department in organizing this, is to organize town hall meetings. As we talk, we have one coming up. I talked about it in May in Chira, and basically to get feedback from people, because Bank of Uganda realized that not everyone can actually come to Bank of Uganda, and it made a decision that if people cannot come to the central bank, then the central bank should be able to find people where they are. And that's why Bank of Uganda conducts town hall meetings. Just the other day we were in Mbarara, and we continue to be in different places. So basically, to give you a summary of some of the key things that are happening at the Bank of Uganda, and to tell you that we value your presence here with us today. So let's have an interlude from the DG, and then we'll continue shortly. Ladies and gentlemen, we once again want to take the opportunity to thank you for turning up for this fourth Financial Stability Symposium, which has been organized by the Bank of Uganda. We apologize for the late start, but we should be able to start shortly. I still wanted to remind you that there are two major things we are going to do today. That one, we are going to have a presentation on the performance of the financial sector as at the end of March 2024. The same presentation will really hinge on the new regulatory developments in the financial sector that have been occasioned by Bank of Uganda. And then also in the same presentation, we'll have a special emphasis on anti-money laundering. And then we'll give you a chance to ask questions. And just to remind you that you'll ask your question in two ways. One, you'll put up your hand when that time comes so that you can actually ask your question, and then the team from the Bank of Uganda will actually answer you. And I've already introduced you the team from Bank of Uganda, which is here to do that. And then two, in case you're unable to put up your hand, or in case you want to but time is not enough, I will advise that you write your question, and then we'll read it out and then have that question answered. And that session, which is the Q&A, is very key for us because we want to get feedback from you. We want to hear from you. We want to see how we can serve you better going forward. So please just prepare that feedback. But once again, to remind you that in that folder you have a registration form. So I kindly request that fill in that registration form before we get into the main business, so that we can have information about your attendance. And then the team from the Bank of Uganda will pass around to collect that registration form. But also to remind you that when we get towards the end of this symposium, we will actually request that you fill in that evaluation form, because again, we want that feedback from you. Please complete that evaluation form towards the end of this symposium, so that Bank of Uganda can review that feedback, and then we see how best we can serve you even much better going forward. And then lastly, there is a presentation in that folder which is going to be delivered today. It's actually an abridged version of the report. So if you want to familiarize yourself even ahead of the presentation, that report on the financial stability risk assessment is actually in that folder. Please feel free to peruse through it so that it informs your asking of questions later on after we have finished the presentation. And once again, we want to recognize these key stakeholders organized in their respective institutions. The GCIC, thank you so much for coming. The academia, notably Rachel from MOBS, thank you so much for coming. And also, of course, the financial institutions licensed, regulated, and supervised by Bank of Uganda. There are quite a number here. Thank you so much for valuing this symposium, and thank you so much for coming. And of course, our sister financial sector regulators, I saw IRA, thank you so much for coming, because we are in this together, and we are committed to making sure that together we can have a sound financial system. So we need that collaboration, and we are happy that you found time to attend this engagement. And of course, our people from the media, we cannot thank you enough, because you're the only people who can amplify this message which is going to be delivered today, so that it trickles down to the common person. So the media, members of the Fourth Estate, we appreciate your presence, and thank you so much for finding time to be here with us. Once again, to remind you that this is going to be an interactive session. So please, when we get to that Q&A session, in case you have any question, please do not hesitate to ask that question, and then the Bank of Uganda will gladly respond to that question, so that actually we clarify where necessary, but also emphasize why this is actually important. Ladies and gentlemen, please allow me to take the pleasure to recognize the arrival of the Executive Director Supervision at the Bank of Uganda. And I told you as soon as he arrives, I'll call him what he prefers to be called. So he's Titi, but also you can call him Twine. Twine, thank you so much for coming. And on that note, please allow me to now embark on the formal program. And on the program, we are going to start with a word of prayer, which is going to be led by Yedida Nyakato. After the word of prayer, we are going to get opening remarks, which are going to be delivered by the Acting Director Communications Department at the Bank of Uganda, who is none other than Mr. Andrew Elwana, and is already here with us. And of course, just to remind you that we have a presentation, and that's why it is here to deliver that presentation on the performance of the financial sector as at the end of March 2024, and also talk about the new regulatory developments as well as anti-money laundering. And like I indicated earlier, we'll eventually crown this all with a Q&A session and a vote of thanks. So once again, thank you so much for coming, and my name is Robert Wagonza, the moderator. At this juncture, let me now take the pleasure to invite Yedida Nyakato from the Communications Department, Bank of Uganda, to come and commit us to the Lord. Yedida.
Good morning, everyone. It's such a great honor seeing you here this morning. I request we humble ourselves for a word of prayer. Father, we want to thank you for this morning. We want to thank you for the wonderful people you've brought here and those that are yet to join us. We pray that whatever we discuss here, Lord, should make sense and will be trickled to the last person in the best message that they understand. We pray that you continue to guide us in whatever we do as we serve this nation in all aspects from where we've come. Lord of mercies, we pray believing with thanksgiving. In Jesus' name, amen.
Amen. Thank you so much, Yedida, for that wonderful prayer. Ladies and gentlemen, we are now going to receive opening remarks. Let me now take this singular honor to invite the Acting Director Communications, Bank of Uganda, Mr. Andrew Elwana, to come and deliver the opening remarks. Andrew.
Thank you, Robert. Thank you. The Executive Director, Supervision, Bank of Uganda, Dr. Twine Manzi Tomoboine, Heads of Treasury and Financial Market Departments of SFIs, members of sister regulatory houses, our colleagues from the academia, colleagues from the civil society, staff of Bank of Uganda, the media fraternity, distinguished participants, our online audience, ladies and gentlemen, good morning to you all. I am pleased to welcome you to the 4th Bank of Uganda Financial Stability Symposium. Thank you for all honoring our invitation and choosing to participate in this event. I believe it will be a positive and fruitful engagement. The Financial Stability Symposium is one of the critical engagements aimed at meeting Bank of Uganda's objective of enhancing stakeholder confidence. The key purpose of the symposium is to increase awareness, understanding, and appreciation of BOU's financial stability analysis and policy recommendations. It is therefore our hope that at the end of this symposium, we will attain two main objectives. Firstly, explain the Bank of Uganda's financial stability mandate and provide accountability for our financial stability policies and actions. I want to emphasize that maintaining a sound financial system is one of BOU's key mandates. As you're all aware, Bank of Uganda supervises and regulates financial institutions, including commercial banks, credit institutions, microfinance deposit-taking institutions, and forex bureaus to ensure that they all conduct their business safely without compromising depositors' funds. If they fall short of regulatory requirements, Bank of Uganda ensures prompt corrective measures to safeguard the sector's stability. Secondly, today we aim to achieve, and I think this is the more important one, to receive feedback on issues pertaining Bank of Uganda's financial stability mandate from you, our stakeholders. I must point out that from our previous engagements such as this, the Bank of Uganda received meaningful feedback that is continuously being incorporated into the bank's strategic initiatives. As such, we have chosen to keep holding such engaging events, and your active participation will be highly appreciated. At the steering wheel of today's engagement is Dr. Titi, as Robert said, as he prefers to be called, the Executive Director Supervision, who will give a presentation on the performance of the financial sector as at the end of March 2024. He will also present new regulatory developments in the financial sector, including the Central Bank Directive on customer identification for all mobile transactions exceeding 1 million shillings. He will also expound on the progress that the Bank of Uganda has achieved so far in combating money laundering. In order to facilitate all-round discussions between yourselves and the Bank of Uganda, Dr. Twinemanzi is accompanied by a team of staff from Bank of Uganda who will jointly contribute to today's discussion. I would like to thank Robert for comprehensively introducing them much earlier. Therefore, I encourage you to actively participate in the interactive Q&A session that will follow after the presentation. Now, ladies and gentlemen, without further ado, I now take the singular honor of inviting our guest speaker of the day, Dr. Titi, to make his presentation. I wish you productive deliberations. Thank you for listening to me. Dr. Titi, you're welcome.
Precise, concise, and to the point. Thank you so much, the Acting Director Communications at the Bank of Uganda, Andrew Elana. And ladies and gentlemen, you'll agree with me that Andrew deserves a big round of applause. Now, before we get to Titi's presentation, I will ask the DJ to give us an interlude. DJ, just a bit of an interlude, and then we can have the presentation. This is a very important high-level presentation which Titi is going to deliver, and therefore we want to make sure that you get the best out of it. So in the meantime, DG, some interlude, then we will have the presentation shortly. Thank you.
Okay. Good morning, everyone. Apologies for coming late. While I wait for them to put up the slides, which you all have copies of, so the presentation I'm going to make today, which is slightly condensed, I hope. The focus first is talking about key risks to financial stability within the economy. Then I'll give an overview of the banking sector risks and resilience. We'll look at the performance of the payment systems, provide an update on regulatory developments and ongoing projects. Then our outlook and policy implications, that is from a Bank of Uganda perspective. And then we'll have a discussion and Q&A. Like Elwana indicated earlier on, I always prefer that this is an interactive session. So I do not want it to be where we are talking at you. I'd rather be that we are talking with you. So if you have questions, you need clarification on any matters to do with how we conduct or provide oversight over financial stability, please ask. If it's anything outside of that, I kindly ask that you ask those questions in another session. So, matters to do with the impact of the Israeli war on financial stability don't count. Can we have the slides up? I don't know about most of you, but I find that the slides that we handed out, the letters are a bit too small. So despite I've been accused of having big eyes, so for some reason I can't seem to see these letters. Yes, so so from a financial stability point of view, the number of risks that we tend to focus on, major risk groups, not risk subtypes, but major risk groups. And if you look at the slide, I think slide number 2 or number 3, where we have a summary of key risks. So overall, the risk rating for the economy from a financial stability point of view is medium and stable. But then that is subject to a number of caveats and conditions. We are seeing steady recovery in domestic economic activity. We're seeing that the number of banks, or the majority of banks, and also in aggregate, have got strong capital buffers. And at this time, despite slight tightening of monetary policy at the last MPC, the effects of the pass-through of those effects are yet to come through. So for now, it's amber and stable. From macro risk, for macro risk, we've noticed a slight downturn in inflation, slowed government borrowing. However, the direction of these risks tends to be dependent on the pace with which highly indebted households and farms remain resilient to higher debt servicing burdens. This is basically more or less, also has something to do with the fact that during the COVID period, when we allowed for, I won't call it massaging of asset valuations, but we allowed for moratoriums and credit reliefs, the impact of that on balance sheets is happening with a lag. So there were farms that had their loans restructured, and of course, which means in most cases the interest was capitalized. So there's a slightly higher burden on some of those farms. Now in this post-recovery period, the firms are having to contend with slightly higher debt burdens, and with, like we said, with slowed economic activity, or at least a slowdown in economic activity, it's increasingly becoming a bit hard for them to meet those burdens, the increased debt levels. So the expectation is that in the short term, there is a bit of resilience they're demonstrating, but over the long term, we expect that the full effect to finally kick in. Liquidity and funding risk. Again, funding costs have risen. Deposit growth has slowed down. So that's still medium risk, but increasing. Credit risk, and this one you might find hard to believe, is still medium, even though there's going to be a slight uptick. We expect a slight uptick going forward in terms of our projections. Notice that throughout this period, one thing that has kept more or less constant is the NPL ratio. And you might ask how. So the thing is, and this is a result of the cooperation we have with the financial institutions, a number of them, or the majority, have increasingly been quite prudent in terms of how they provisioned for loans. And also the fact that we adopted IFRS 9, where your expected credit loss models and your probabilities of default, you've erred on the prudent side in terms of providing for some of these facilities. So with earlier provisioning, the NPL ratio has, and even write-off in some cases, the NPL ratio has still remained constant. Profitability, in the aggregate, even looking at the numbers for end of December, there's been improved profitability and improved capital holdings. So by extension, one would say that one can argue that solvency largely has also improved. However, the question then becomes, when we project, where do we see this going? Is the current profitability and the current resilience that we see sustainable over the medium to long term? And there's a slight risk to that because, again, especially looking at the nature of our economy, being landlocked, not being significant exporters, not having a significant export income, there's a likelihood that some of the external shocks, especially geopolitical shocks that now currently are feeding through to costs of transport and supply chain, will have good impact on the supply chains, will feed through and affect margins and therefore profitability of the institutions. Market risk. We do agree that earlier on this year there was a significant exchange and interest rate risk volatility, especially in the quarter ending March 2024. And further widening of interest rate spreads could result in elevated funding and credit costs, with a knock-on effect on financial institution profitability. Structural risk, this possibly is the only one where we've seen a significant improvement. Banking sector concentration, in terms of as measured by the Hashman-Huffington Index, has actually dropped. When we look at the share of the domestic and systemically important banks in terms of bank assets, this has reduced from 64.4% to 61.7%. Aggregate banking system exposure to the largest depositors has also reduced, and this also further reduces concentration risk from funding side. If we now turn to domestic macro developments, so Uganda's economy and the banking sector remain resilient amidst domestic and global challenges. There we have numbers, you see, quarterly GDP. From the quarter on quarter, sees about a 20% basis point increase. And according to UBOS, this is largely explained by rises in industry and the service sector. Headline inflation, 3.3% in March 2024, compared to 3.4% in Feb 2024. that's a 10 basis point drop, but it is nevertheless significantly still higher than where we're at the end of December. So yes, inflation has gone up, but it's kind of moderating. And government borrowing has also slowed. When you look at government borrowing over the period, it now accounts for only about 30% of banking sector assets. Domestic macro developments. I will not explain too much. I will not go too much into that chart, but I think I will just focus more on what we have seen. Like I mentioned earlier on when we were talking about market risk, the exchange rate volatility that we noticed in Q1, especially in the first half of Q1, basically was one of the key triggers, not the only one, but one of the key triggers for the tightening of policy in the period from 9.5 to 10%, 50 basis points. And also at the same time, we also noticed that there was increased vulnerability to short-term investor outflows. So in that quarter, there was a net reduction of 243 billion in offshore exposure between Jan and Feb alone. So the implications of the outlook, we think that was more or less like a one-off, so it's not something that we expect to keep on happening. But nevertheless, these conditions are likely to continue weighing on the banks, the performance of financial institutions, and we are yet to fully see the pass-through effect of the tightening of policy in Q1 of this calendar year. Our assumption is that outside of that outlier effect, that blip in the volatility, we expect that the market shall largely remain stable, and that therefore inflows, we expect to see a return of a positive number on inflows over the period. Funding and liquidity. These tightened in the quarter ending 2024, naturally. Interbank funding costs also rose slightly. Financial institutions deposits increased to 34.8 trillion. And here's the interesting thing. That was largely because of a 3.4% growth in time deposits. Which means, because time deposits tend to be a reflection of confidence in an economy or in a sector. So, in other words, financial institutions now, it appears, are looking for more stable funding as callable deposits that are taking longer to recover post-pandemic. Now, I'm not saying that of course, the cheapest source of funding for any financial institution tends to be demand deposits, but those tend to be very volatile and subject to the expectations, subject to sentiments and expectations around them that often are beyond the control of the financial institution. So we're seeing an increasing reliance on time or term deposits. And the fact that those funds are actually available is also indicative of the fact that there is increasing confidence within our financial sector. So in our assessment of liquidity risk, the liquidity buffers remain strong in the aggregate, although there was a decline in cash and investment securities held by banks. The aggregate liquidity coverage ratio reduced, and all financial institutions, with the exception of one, at the end of March 2024, met the minimum requirement of 100%. Liquid assets to the liquidity ratio increased, and for all financial institutions made the regulatory minimum of 15% for MDIs and 20% for CIs, 15% for commercial banks and 20% for CIs and MDIs. The outlook is strong economic growth and increased market stability expected to drive improved liquidity conditions for the banking institutions. Also, and this is largely on the back of the fact that most financial institutions hold sufficient liquidity buffers to meet short-term obligations and absorb potential liquidity shocks. So, for those who had been worried about the Bank of Uganda bumping up the minimum paid-up capital at the end of 2022, you begin to see some of the things that we saw then, because now the institutions are going to be in a better place to absorb any shocks, or at least the shocks that we expect to see over the medium term. I also like just draw your attention to table 1, which is the bottom right of your slide, of the slide, and just take a look at the average spread on the interbank rate versus CBR, the average spread on the FX swap. You'll notice something quite consistent here. For the spreads, on average, there tends to be between a 20 to 30 basis point increase. The interpretation of that is entirely up to you, but for us, it has potential implications for liquidity, and hence the concerns, not yet elevated, but the concerns that we have over funding and liquidity over the medium to long term. And when you look at the liquidity ratio, that has remained more or less constant. So especially for the treasurers in this room, I would like you to draw attention to this particular slide and just begin to appreciate that whilst we are stable, whilst we appear resilient, we see some dark clouds over the horizon, unfortunately the majority of which we don't think we even have control over. So they say forearmed is forewarned. So it might be necessary for institutions to go back and just look at how they are planning to manage their liquidity over the medium to long term. Credit risk. Credit growth, especially measured as PSC, which is private sector credit growth, remains below its long-term trend. The outturn for end of March was 6.7% versus a growth target of 13%. So that is a significant underperformance. And when you look at the slide, on the top right, on the same slide, the figure on top right, it talks about Uganda's private sector growth as to GDP for as a ratio. You'll notice that where the solid line represents the long-term trend for PSC as a ratio of GDP, actual credit to GDP, the gap is measured in the green line represents that. And you'll notice that while it appears to be more or less constant, you notice there have been some ups and downs in the past, and this is smoothed out. But if one was to look at on a more granular level, we expect to see some further bumps going forward over the medium term. Like I said, credit growth has slowed. Now, if you look at the average weighted lending rates, those have also gone up. Now, partly it's because of tightening, but we also think it has something to do with risk averseness within the economy and uncertainty about where we'll be over the medium term. Your assumptions as to where the origins for those uncertainties probably will range from the way government intends to fund its activities over the medium term, expectations or the implications of the World Bank review of their lending to us, and the fact that there are certain obligations that we have as a government and certain that are coming due over the next 2 to 3 years, for which perhaps one would say funding is not yet quite certain how that's going to be done. So I mean, it's only prudent that then exposure to high risk investments like private, exposure, increasing private sector credit for the financial institutions, you kind of have to ease on the accelerator, not to say slam the brakes, but while you figure out and try and understand where this whole thing is going. Now, however, of course, then the question then becomes, but if that's the case, how come there seems to be an uptick in lending to households and real estate? We don't have any firm theories in terms of why that is the case, but we are hoping that with some of the interactions that what will come out of the household survey by UBOS will help us understand what is driving this. Perhaps is it that real estate is being seen as a possible safe haven or safe asset for households or for household income? We're not very sure. On the next slide, we'll see on credit risk. Asset quality has started to deteriorate, which again is not really quite surprising because, like I said, considering the forbearance that was applied to asset valuations during the credit relief measures during the COVID period, we expect that, with a 1 to 2 or 3 year lag, the final impact in terms of actual NPLs will begin kicking in. However prudent the banks have been, we expect that now increasingly some of those firms that had managed somehow post-COVID to be able to manage, if the conditions, the uncertainty around the economy remains as it is, we expect that some of these firms are going to begin to struggle. That's one. Two, and part of the reason that motivated the increase in the base rate the last Monetary Policy Committee, there are all these expectations or rather sentiments about where inflation is going. And inflation tends to be a driver, especially for import-based economies like ours. When you have inflation that's largely imported, and capacity or aggregate demand not growing as fast, then performance of borrowers who are largely in the sectors that are reliant on imports tend to suffer. And not surprisingly, again, the highest NPLs tend to be in trade. Because most of our trade is, I would say, largely we are net importers. So if the majority of the importers are subject to all these disruptions to the supply chains, you have inflation rising, so even the ability for them to be able to replenish their stock of goods using Forex, it will be, for me, it's not surprising that subsequently they should be facing problems over the medium term. And we expect this most likely to persist unless, of course, we hope to be kind of muted by our expectations about certain inflows regarding the oil and gas industry and the investments in this country over the next 1 year or so. So, capital adequacy and profitability. Growth in capital is mainly driven by the increase in equity to meet the revised regulatory minimum paid-up capital requirements, whose deadline is June 2024. All financial institutions met the leverage ratio of 6%, and the capital conservation buffer risk to 12.5% to risk-weighted assets. And that, I think, is a good thing in terms of indicating resilience. With the systemic risk buffer, all domestic and systemic and important banks, at least as of end of March, were compliant. The figure on that slide, figure 7, will show you where the most, you'll notice that the core capital, the core ratios for capital have tended to be most, have had the most big bumps and moves for credit institutions. And which other group is that? The MDIs. Now, I don't know whether it's a question of either scale in terms of the kind of balance sheets they hold, or it has something to do with the kind of customers they serve. Still on capital adequacy. 2D, in the year to March 2024, financial institution profitability was mainly or largely driven by interest income on government securities. NPAT increased by 15.9% to 1.5 trillion. Interest and fees income increased by 13.8% and 14.4% respectively. But return on assets only registered a marginal increment of, say, about 20 basis points. For the non-banks, profitability was reduced due to elevated staff costs and high costs of deposits. Now, one thing that's becoming quite apparent in this is that the non-banks, as the CIs and the MDIs, tend to rely more on term deposits that tend to be expensive. Now, if you put a bookmark on that, I noticed something that we mentioned earlier on, where we said we're also seeing an increasing reliance move by commercial banks towards term deposits because they're less volatile. Okay? The question then becomes, is it about one's ability to attract properly priced long-term funding, or perhaps it's time that the market began looking at alternatives outside of your conventional deposits for loanable funds? So, in terms of outlook, rising funding and credit costs may reduce the profitability of some financial institutions and hinder the ability to build capital in the short term. Market risk. I think for me here, the figure of interest is the figure on the right, figure 10. Okay? One thing is becoming quite clear. Forex lending or Forex component of lending or deposits is on a downward trend. And this is a long-term trend because the figures are from March 2017 to March 2024. That's a 7-year period. So we're looking at about 27 times 4, 28 data points. So over 28 quarters, foreign loans as a proportion of total loans is coming down. Forex deposits to total deposits is coming down. From a financial stability point of view, it means that overall exposure of a financial sector to developments in the the Forex market are decreasing. But then the question then becomes, is it what is replacing this? Because over the same period, total loans have gone up. Total deposits have gone up. So the question now becomes, which is something I hope we can have a discussion about, just to pick your brains. What is replacing this component? Market risk developments in the real estate sector. So while bank loans to the real estate margin increased by 0.15% or 15 basis points, loans for residential, commercial, and property development declined. And this sector NPL rose from 5.5 to 7%. Now, again, let's look at the implications and the outlook. Is it the stability in the foreign exchange market is expected to support more lending to the private sector? But then, if that was the case, how would that be happening when, especially for real estate, where the bulk of the funding tends to be Forex denominated? Is it that perhaps there's less borrowing in Forex for the real estate sector or for the property development sector? Again, these are questions which we are putting to you and which hopefully we can have a discussion about. Payment systems. Liquidity risk was rated low for the quarter ending March 2024. Operational risk was rated moderate, but moderate and increasing. Why? The continuing incidence of digital fraud amongst all financial service providers and PSPs has increased. At the same time, I just want you to take a look at the figure on the left of the slide, the bottom left. One form of payment appears to be constantly increasing, and that's mobile money. Internet banking transactions, we're seeing a dip. Point of sale transactions, we're seeing a dip. The only ones that have kind of leveled out is debit card transactions. So if debit card transactions are more or less flat, mobile banking is going up. Mobile banking transactions, yes, is going up. Mobile banking and mobile money are going up, with mobile banking going up slightly. Internet banking dipping. Would the dip in internet banking, for example, be explained by the increased fraud on that particular platform? If that's the case, then as an industry, we need to start asking ourselves, what do we have to do differently? Because when we look at the overall picture from fraud, especially around payment systems, within the payment ecosystem, it tends to originate or have something to do with internet banking, not necessarily mobile money. Mobile money just becomes the way the money is taken out of the system. I will turn to an update on regulatory developments. In February this year, of course by this time you know this, Uganda was finally removed from the FATF ICRG grey list during the plenary meeting. Here's an interesting fact. Uganda was put on the list on 20th February 2020. We got off 15th February 2024. Took us 4 years. And I think there's a thinking within Bank of Uganda, broadly across financial sector regulators, is that that's one place we should never go back to. But then that means there's going to be a change. There's going to be a change in the way business is done within the financial sector. There's going to be enhanced stringency around identification, transaction monitoring, alert investigation, suspicious transaction reporting by the financial institutions on all transactions. Because now the penalties, when you look at the amendments to the Mobile Anti-Money Laundering Act regulations, the penalties are now a really tidy sum. The other changes we've made, we amended the Credit Reference Bureau Reporting Regulations 2022, and as of 31st January this year, the FCS card is dead. So from 1st February onwards, any transaction with a bank does not require an FCS number anymore. It's actually now illegal to ask for an FCS number. Your national identification number is your credit identifier. And the plan is that we shall move to an environment where you'll have your NIN and a credit score as opposed to just a credit report. The other development as a result of these regulations is that we are finalizing that we came up with it's called the criteria for accrediting credit providers. The universe of those reporting to the CRBs has expanded. So it's now no longer just deposit-taking institutions. It is any institution that provides any form of credit. Utility companies, car dealers, name it. Anyone who provides any form of trade credit is now eligible to submit information to the CRB and pick information from the CRB. So one's credit profile is going to be, we're not yet quite at 360-degree assessment, but it's a much wider view of a person's usage of credit. I know some of you who are in your credit departments have had a problem where you have borrowers who also are exposed to money lenders and other financial institutions, and then you end up having clashes with their ability. When you're expanding credit to them, you don't take into consideration their existing exposure elsewhere. That's going to change. Oh, that's also means members of investment clubs. If your investment club signs up and you don't pay, then and SACCOs. Okay, talking about SACCOs, the regulations around the supervision of large SACCOs were also passed. Unfortunately, the Uganda Cooperative Savings and Credit Union filed a petition against Bank of Uganda and Attorney General contesting our mandate, but it's in an act. So our response to them was, if you don't want us to look at the large SACCOs, go and amend the law. There's another push that Bank of Uganda is including, and that is environmental, social, and governance, ESG. The current approach is that we're saying, as financial institutions, you come up with your own framework based on your risk appetite, your business model, and the focus of your businesses, in terms of how you incorporate this in your conduct. At the same time, what we have done as Bank of Uganda is we've shared with the industry climate change risk management guidelines for comment. We'll have a subsequent validation workshop with the industry. And those are going to be the guidelines where, next time when we're looking at the way you manage risk within your portfolios or on your balance sheet, our focus will be to what extent is your balance sheet exposed to climate change risk, and how do you manage that risk? It might be in credit, it might be from an operational perspective, it might be from market risk, it might be from strategic risk. That's entirely up to the institution. So what we're doing in these credit risk management guidelines is providing a minimum, think of it as a baseline, a minimum that we expect to evaluate you on with regards to how you manage this particular risk subtype. And also, just for your information, the Basel Committee on Banking Supervision at the end of April published the revised BCP. BCP is the core principles, the banking core principles. So the most updated version was published at the end of April. And I will just give you an example in something that has changed or that's going to change within your industry. Conventional in the industry, from a financial stability point of view, when we talked about concentration risk, we're basically looking at deposit, in terms of depositors and in terms of loans. I think it's BCP 24 or 29. It's been updated. So concentration risk now goes beyond just deposits and loans. It will look at sector exposure, geographical exposure, climate, like I've indicated. It will look at even what they call vendor exposure. It is, as an institution, third party. To what extent are you subject to concentration risk from the vendors that provide you, the third parties that provide you a service? Okay. If you have one vendor providing 80% of your services, you're probably subject to vendor lock-in. So that's a form of concentration that's also going to be addressed. So I would advise that, even from a liquidity funding point of view, so I would advise that you also take time out to look at the most updated BCPs. I believe they were published on the BIS website, bis.org. just to get an understanding in terms of where even we as Bank of Uganda will be going. So overall, outlook and policy implications. Systemic risks are moderated during the quarter ending March. In aggregate, the banking sector remains stable with strong capital buffers. Aggregate financial institution performance will depend on economic growth prospects and the evolution of several tail risk scenarios. In other words, black swan-like events. Hopefully they don't happen. The outlook for macroeconomic financial conditions is to stabilize as the effects of monetary policy tightening continue to pass through to the real and financial sectors. Now, of course, being a country that's import dependent with a significant part of our reserves in foreign currencies, it is also necessary that we also sit and estimate or understand, try and appreciate the impact of monetary policy decisions in certain jurisdictions on our ability to respond. So the one thing we have done as Bank of Uganda so far, we've tended to be to ride ahead of some of those jurisdictions in terms of where we think their policy directions are going. But recent indications are that we don't expect a pivot in terms of position from the central banks of some of the that manage some of the major currencies. So the period of heightened reference rates or high CBR might persist for some time, which also then, of course, feeds through to the cost of lending to the private sector, will probably make it more difficult to increase possibly NPLs in the sector and also further reduce even the lending to the private sector. So I think one of the things we say, or I just want to bring to your attention, is that normally we have this thing called the counter-cyclical buffer, where, as someone once said, that central bankers tend to be like the person who takes away the punch bowl when the party is getting heated. When we see an overheating or rapid growth, especially in credit, there's a tendency, or when the good times come in, there's a tendency to require banks to save a bit more. So the counter-cyclical buffer, we are still maintaining at zero, because we don't see a periods of, even though profitability across the board has increased, we don't think it is excessive, or to use the words of Greenspan, irrational exuberance yet. Now, on the directive for the identification of mobile money customers, remember I indicated that the majority of fraud tends to start with mobile internet banking, but the cash out, because those frauds only work to the extent that someone can actually convert the money to cash. Those cash outs tend to happen over the mobile money platforms. So there was a directive issued around the 1 million shilling limit. On this one, I won't say much. I'll ask one of my colleagues from the payments department to take you through the thinking of the central bank on how that was arrived at. But even while we do that, like I said earlier on about money laundering and national security, increasingly the two are getting tied together. You see, normally before when you look at the predicate offenses for Uganda, the main sources of AML risk. So there's corruption, there's fraud, wildlife offenses, and tax evasion or evasion. So those are the main sources of AML risk. But when you come down to fraud, and the fact that Uganda is involved in a number of countries within the region in terms of providing or ensuring national security, the fraud component has now increasingly taken on a national security perspective. And that's why I said, going forward, mistakes or omissions around AML risk are going to become extremely expensive for financial institutions. You would rather err on the prudential side, because it's no longer just about fraud and the illicit financial flows within the financial system, but there's now a national security perspective to it. In actual fact, I think some of you are here members on the National Fraud Task Force, which is basically chaired by members of the security forces. So that was one important point I wanted to make, that AML risk or fraud risk has taken on a national security perspective. And that in your conduct of business, as you do your KYC, or as you verify transactions or transaction monitoring or alerts or suspicious transaction reporting, be mindful of that, because now the consequences are far beyond just illegal money flowing within our financial system. So, ladies and gentlemen, I hope it did not take too long. I will thank you for your ears. Now, if I can also have your lips and you ask questions. Thank you very much. Yes, Albert. Take a come. This one is your monkey. Mr. Ntege here is from the National Payments Department at Bank of Uganda. And on the directive with regards to the 1 million shilling limit, please explain to them. Thank you.
Thank you very much, Dr. Titi. Ladies and gentlemen, I'm Albert Ntege from the National Payment Systems Department. I think it's okay. I'll quickly delve into the issue, but I just want to give a brief background. And let's be, the traction in terms of mobile money transactions is really peaking. And the usage right now, if you look at the FinScope survey report that came out recently, you have about 64% mobile money users in Uganda. So the uptake, we can see that it is really increasing. So we had to find a regulator. The regulator had to come in and get what we have, the National Payment Systems Act, I think, which you're aware of. I don't know how many of you have read it. But to delve into the matter of identification, we have section 55(1)(b) that requires mobile money customers to identify themselves for all deposits and withdrawals. It is not that there was no regulation in terms of whether customers should be giving those identification, but there was a regulation and there's a background to it, and that is one of the justifications. And Dr. Titi has touched on matters of digital fraud. The typology in terms of digital fraud, he's touched on the internet banking. We've had so many of these aggregators. We have the bank to wallet to bank. That is one of the typology in which the person in between comes there. Usually they steal people's mobile phones. And if someone has registered for bank to wallet to bank, they tend to be exposed. But now the liquidation happens on the mobile money platform, as he has clearly explained. So that liquidation on the mobile platforms is, of course, with our agents who are always having the float. So that is where the liquidation takes place. And the need for identification, the directive was required the need for identification for anybody, every customer who is going to withdraw this money from those agents. Now, justification, why the 1 million is a question for, why everyone has been coming up and saying, why 1 million? Why did you say, why not 2 million, 3 million? We are cognizant of the fact that there's a need to balance what we call safety and the convenience. But when we look at the statistics, 98% what we call low-value transactions, less than 1 million. The person who does the 1 million between you and me are just 2%. Are those the ones who are complaining? Why don't there are banks, there are other digital channels they can use. Where identification to them is normal. It should be. It's part of the need to identify yourself and be able to transact and make this sector safe. So the 1 million, that's the justification for the 1 million, and some of the issues, of course, some someone will ask and say, the data relating with the agents, how they're going to, we're going to work with these service providers to make sure that medium term, the biometrics, we use the biometrics verification, but in the meantime, they'll be probably registering in their books. As you know, when you go to this agent and withdrawing money, then give your ID there, more than 1 million. They pick up your ID number and then just fill it in the book and everything. Maybe you will also be leaving a photocopy of some sort to the agent so as proof. This is who you are, but that is the justification and how the implementation is going to go. Thank you very much if I've really touched much on that.
Well put, Albert Intege. Thank you so much. Indeed, there is a need to balance between convenience, safety, but also risk. Yeah, thank you. Ladies and gentlemen, that was just an addendum to TT's presentation. And now that TT's presentation is done, I want you to join me in thanking him for such an organized, insightful, and thought-provoking presentation. Thank you, TT. Now we go for question and answer session. By show of hands, I want to see who goes first. Okay, over here. Mention your name, the institution, then your question.
Thank you. Oscar Mwanga from Standard Chartered Bank. And I'd like to thank Dr. Titi for a very insightful presentation. I think there were some details that were quite useful in there. I have two questions. I think you spoke rightly that there's 1/3 of deposits, bank assets actually, in government securities. And all the risks we've covered here are you looking at supervised financial institutions. And given the risk that we have to government, the exposure, who's looking at them? Because any delay to pay feeds into credit, feeds into liquidity. That's one. But secondly, that loop appears to be accelerating, where as we lend less, or as we err more on the side of caution and lend to government, that risk increases. And that it feels as though the cure appears to be the cause as well of our situation right now. The second one, you spent quite a bit of time on slide 5 regarding the changes in offshore holdings. And as you spoke about that, I got to thinking, we've also seen our FX reserves not go anywhere. If anything, they've actually shrunk. And I'm wondering, isn't there also a risk there that we might not be able to meet our foreign currency obligations in the near term? And yeah, those were the two questions I had from your presentation. Thank you.
Titi, do you prefer that you respond to a batch or just? A batch. Okay, sure. Thank you. The next person.
Thanks, Titi, for the presentation. My name is Charles from Exim. Mine are also two and mainly coming in from slide 7. You pointed on your presentation mainly highlighting the costs of lending. Now, the latter presenter mentioned about FinScope. FinScope highlighted a drop in banking activity from 21% in 2009 to about 14% in 2023. And while the other channels of banking went up from 7% to 54%. Now, this spells to one of the reasons you mentioned why commercial banks are preferring to take term deposits to stabilize funding, because CASA is impacted here. And this directly feeds into the cost of deposits and the price on the base rate, and as well prime lending rate. And then in your presentation, I wish to hear how BOU is looking at reducing the CRR. I think it stayed for long, and the economy, we're looking at the economy recovery. And the cost of CRR, even though the foreign currency deposits have dropped, it is still a significant portion in most of the banks, and it's impacting on available liquidity to lend, which later on as well translates into the cost of credit. So in those two perspectives, wondering what is BOE looking at to first make sure the cost of liquidity is coming down by probably relaxing the regulation on CRR02. And what are we doing to improve preference into commercial banking? Some of the interactions with customers, initially customers were mentioning the stringent requirements in opening bank accounts, but the later one has been a URA impact on accounts where the accounts get frozen and they are short of liquidity. So it's also tending behavior to preference to cash. So I don't know if BOE is working with the other partners in the tax sector to see that such character does not translate into cash preference and banking, which will impact the growth of the financial institutions.
Robert Intege from Citibank. Thanks, Titi, for the presentation. Mine, I think, is starting with a story. 2016, the twin deficits were up. That's a current account, fiscal, were up. That's 2016, the election. 2011, those of you with long memories, same thing. Twin deficit, up. FX, up. 2021, 2020, you could argue we were lucky. We had COVID. Based on COVID, we got flows from the World Bank. Again, you may recall that the IMF program was just starting. So we had a bit of cash from both those institutions. 2026, and if I may quote you, you're saying that within a year, we expect FX flows from the oil and gas sector. And I understand that even Bank of Uganda uses these models to look at the future, to say we expect to build our reserves from 3 months of import cover where we are now, which is quite low, as Oscar talked about. We are saying in a year's time, we expect our friends at UNOC to start receiving some flows. But remember, 2026 as well is an election year. My question for you, with all the noise on IFRIS, with all the noise that URA not collecting enough for this fiscal year, I think we're now behind by 2 trillion shillings, right? How is Bank of Uganda planning for this particular event? From where I'm sitting, it looks like we're having a perfect storm to have a proper blowout on both FX and rates. Thank you.
Rita, you can get that question over there. And maybe it could be the last one for this batch, then TT response.
Thank you so much, Dr. TT. I'm Noamanya Ronald from UBA. My question is on the whole outlook of the economy. Uganda's debt position increased by over 3.5%. That is to 96 trillion. In your presentation, you highlighted that the government borrowing is at 30% of the bank assets. However, we realize that it is having a challenge because IMF has a limit of 50% borrowing rate, and for Uganda we are already at 52% borrowing rate. So how are we managing the distress? And with the URA projected collections being 31 trillion, how are we going to meet the gap? Because you realize what is collected is spent, and the debt servicing is at 35% of the GDP. Are we going forward in the distress position, or we are going to curb it down? Then another one would be on if BOU focuses on banks, financial institutions investing in government securities, meaning less liquidity will be left for credit and ordinary customers. So if we don't grow the credit business, how is the public going to generate revenue that would be able to meet the budget gaps? Thank you so much.
Thank you so much. TT, you may now respond to the questions that have been asked.
Yes, I'll start with the last question. Regulation of the financial sector, and at the same time regulating the monetary sector. If you look at the mandate of Bank of Uganda, price stability and financial sector stability, you have kind of two opposing points here. When you grow, when you allow private sector credit to grow, which is the good thing, okay? It increases, tax receipts, there's economic activity, and general expansion of the economy. But on the other hand, when the data points to heightened inflation, like I said, some of the developing country economies whose decisions tend to pass through to us are not about to pivot from their position in terms of reducing the reference rates. So we also have to worry about inflation. Now, one of the key tools to managing inflation is controlling aggregate demand. Okay? So if in controlling aggregate demand, it means that we put a damper or a ceiling on credit, just so that with the pass-through effects, so that inflation can be controlled and get to a level where it is sustainable, then we have to. Because the problem is when you let inflation run away, inflation, once it goes beyond a certain point, is no longer tameable. You have to go through the whole gamut of hyperinflation before you come back again. So the thing is, you'd rather take some bitter medicine now, possibly even put a restriction or constrain growth now, so that you have inflation contained, and those who are making decisions about investments can have some prediction in terms of where the price level is going to be 2, 3, 4, 5 years down the road. Not even 10, but 2, 3. So it's that push and pull between growing private sector credit and managing inflation. Because managing inflation requires making certain decisions that actually contradict growing private sector credit. So then now it goes back to the issues, okay, we've talked about all these death numbers for government. One of the things I know for sure what the government is trying to do is fiscal consolidation. I think there's a general understanding now that fiscal policy needs to be tightened. Whether it's politically tenable, whether they'll actually be able to do it, I don't know. But they know they need to. And when you talked about the 50% debt ratio to GDP, I think for me a better indicator would be what percentage of your debt repayments vis-a-vis your receipts, as opposed to just the GDP. When you look at some of those numbers, yes, they're actually very concerning. And the only solution is cutting back on certain government expenditure. But since government accounts for almost 65% of aggregate demand in this economy, if they cut back, it is the equivalent, again, of shrinking aggregate demand. Then you will hear the whole story of there is no money. So we are stuck between a rock and a hard place. Okay? But are we approaching debt distress? Are we debt stressed as a country? Not yet. No. But if we don't make some fundamental changes, at least, well, not from Bank of Uganda side, but from the fiscal policy side, there need to be some fundamental changes. And I know that there has been a commitment by the fiscal policy authorities to reduce and manage fiscal expenditure. You all recall when the PSST announced that they were going to cut the budget of Parliament by 50%, and I think if they could impeach him, they would have impeached him. Okay? But those are the kind of decisions that have to be made. For some of the quarterly releases, most times they're only releasing for recurrent expenditure. CapEx is coming down. Some of you banks have lent companies doing work with government, and they're not being paid. There's a deliberate, to try and rationalize government expenditure. That's the only thing I can do. We can't do it as Bank of Uganda. We can only advise. My friend from City, it's interesting. I had this conversation with him many years ago. Bumped into each other somewhere. Yes, the Twin Peaks happened in 2016. It was there 2011. 21, I think we kind of got by. You're right. We're lucky. Will it happen again in 26? I don't think so, and here is why. One, these events don't follow a normal distribution. That because it happened in the past, therefore it will. That's one. And if you look at the structure of the economy, 2011 and 2016, and where it is today, it's a bit different. What did you say? From a structural perspective, it's fundamentally different. It's still the same economy, but it's fundamentally different. So, is it possible that the conditions that allowed for the Twin Peaks in 2011 and 2016 shall be repeated in 2026? I don't think so. But on the other hand, we might end up with a triple peak instead. It might be something worse or something better. I think the more fundamental issue is, okay, we know 2026 is coming. We know what that means in terms of government expenditure. We know what that means in terms of the move away from productive activities to non-productive speculative activities within the economy. The question then becomes is how do we position ourselves or prepare ourselves for that event and what it might mean for your balance sheets and even for us as a central bank as our balance sheet. But the circumstances that prevailed in 2011 and 2016 for the Twin Peaks, and we had this conversation, I don't think 10 years down the road still prevail. There was a question about growing preference for cash. I don't know whether that is entirely true. Yes, there are stories of people who have cash in the houses, but I don't know about that. The stringency around KYC for opening a bank account, I think, like I said earlier on, is not going to go away. It's only going to get a bit more stringent. And that's why when you look at the financial inclusion strategy, mobile money and all these other alternative forms of onboarding customers are being used. And someone normally starts with mobile money before eventually they move to banking, depending on the volume of their transactions. So I don't think that's going to go away. I'll ask the Director of Financial Stability, Robert Mbabazize, to talk about the issue of CRR. And then I'll ask my colleague here, Huntington Waswa, to talk about the 30% exposure of banks, 30% of bank assets being government securities, what that means for the stability of the banking sector. And who is looking at this, and in terms of if they are, what are they thinking? I'll turn to the issue of slowing FX inflows and the impact on government of Uganda ability to meet its debt obligations. Like I said, there's an expectation that certain inflows around the oil and gas industry, not necessarily to UNOC, but for the entities that are involved in the downstream activities with our national, local content law and so on, there's certain contracts that are being signed and for which we expect to see inflows over the next 1 year, especially if the target of first oil by 2025 is still on. Unless, gentlemen, you know something to tell me that it's not going to happen, and we need to go back and revise our models. But our model assumes first oil in 2025, and for that to happen, certain investments must be made locally. Now, a portion of those investments will come as machinery, but there will be certain inflows that will get converted Uganda shillings for expenditure around those preparations. So, Robert, CRR, and then Huntington on the 30% of bank assets being government of Uganda securities and what we're doing about it.
Okay, thank you, Dr. Tite. I think the question is very simple. When does Bank of Uganda expect to adjust the cash reserve requirement? That's what I understood it to be. And the answer is very simple, that our policy actions as Bank of Uganda are data-driven. We look at the data and then we take action. As you will recall, we tightened the CRR about a year ago because the situation at that time warranted this action. Because we were faced with two problems. One, that inflation pressures had gone up, if you recall at that time. And secondly, we had very strong exchange rate depreciation pressures. These two risks were very strong, and the outlook showed that unless we took immediate action, this would of course pass through and affect the economy. So has the situation changed? Yes. I think inflation kind of moderated, although we've kind of seen some small upward pressures recently. Most of you are bank treasurers. You also know that in February and March, we also had very strong depreciation pressures again. So we are still watching. But the second part of the question was alluding to the fact that because the CRR was tightened, this might be affecting credit growth. If we are honest with ourselves, this argument is not correct. I think banks are sitting on large cash reserves. Sometimes you prefer to give this cash to the government instead of lending it to the private sector. I really think that there is enough room for credit to grow even at the current level of the CRR. So to conclude, we shall continue looking at the data and we shall adjust the CRR when the time is right. Thank you.
Oscar, 30% of deposits in government securities. I think some of these things happen naturally. What attracts lending to government in government securities? There are two alternatives. You can lend to government or you can lend to the private sector. Lending to private sector, as we all know it, as bankers, is very risky because the default rate is high. But more lucrative than lending to government. I think what we need to look at is what Bank of Uganda is doing to attract banks from lending to government to the private sector, which is what Dr. Titi has talked about. He's talked about the changes in the credit referencing system in Uganda. Using the national identification number as a unique identifier instead of the financial card. All these are measures being taken by the central bank to attract banks to lending to the private sector. And these measures are also intended to make it a lot easier for you to be able to identify Huntington as a borrower, which wasn't the case before. You probably raised this issue probably because maybe not much was mentioned or touched in the presentation. The commitment we can give that probably going forward, this is an area we're going to focus on so that the visibility improves. Thank you.
Yes, just before Robert comes in, and just to add on to what Huntington has said. So when one looks at the way pricing is done in Uganda for credit, there are a number of things that go in. So information asymmetry between lenders and borrowers, the first thing the Credit Reference Bureau regulations are going to deal with, okay? All of us in this room also acknowledge, for those who are involved or who have worked with recoveries, that on average when these cases go to court, it's 5 to 6 years. So there's an opportunity cost of that money sitting in court. Someone has to pay for it, okay? And me, the good borrower, I'm the one who ends up paying for it. The other issue is collateral valuations. Banks increasingly, traditionally have always relied on land and real estate as collateral. The valuations of some of these assets, of this collateral, when you actually come to the point of enforcement, more often than not, you recover, what, 50, 60, 70% of the first sale value? And then you expect the borrower to provide the personal guarantee for the difference. And that's why I think maybe as a banking industry also we need to ask ourselves, can't we be a bit more innovative? Okay? But innovative, say, lending against receivables or lending on, contract-based financing, or these are the more advanced, innovative forms of financing, are conditioned on one thing: contract enforcement. Do you have a legal regime that does not give preference to debtors over creditors? Are they both treated equally under the law, or in terms of adjudications or rulings? Increasingly, what we have seen from rulings, is that generally borrowers tend to do better than lenders in judgments. So the banks naturally are saying, something, there are too many negatives. Much as I love the higher rate, I stick with the lower return, which is more certain. But then that defeats the whole purpose of your license as an intermediator mobilizing deposits to lend. So you do little lending and attach such stringent requirements that only a small handful can actually qualify. Now, again, because you're dealing with depositors' money, so it's I wouldn't say it's chicken and egg, but there are a number of initiatives, but some of them require us, even as an industry, looking in ourselves and reevaluating it. For example, if someone is borrowing money, 3-4 year money, for a real estate project, why is the bank lending and giving him 6 months more grace period and saying during that period you have to pay interest? With what? There's no income coming in. Okay? But then on the other hand, someone is putting up a project, apartments, and you're giving them 10 billion shillings on their account. Of course, when he walks out, he looks at his corona and remembers there's Sifao, and then the diversion starts on day one. But some of these loans could be structured depending on what they're doing, and say, look here, you will have a project manager, you will have a contractor with a performance bond to us. We shall not release money to you. We shall release money for the project. And only at the end, if you need operational capital, that's when provided. Then that way you're more guaranteed that there will actually be a project you can collect from. So that if he or she fails, it is easier to move that asset to a asset manager or asset reconstruction company to manage and collect the revenues because you're not interested in the asset. Thank you.
Thank you, Titi. You ask quite a pertinent question. Why can't we be a little bit innovative and shift away from the business as usual mentality? Ladies and gentlemen, that marks the first round of the Q&A session. Thank you, Titi. Thank you, Robert. Thank you so much, Hannington. We are going to the second round of questions, but before that, I want to remind you that you have a registration form in that folder. Kindly fill it in and put it on top of the table so that the team from the Bank of Uganda will collect it. And in that same folder, we have an evaluation form. By now, I know you know how the symposium is, and now you have that feedback with you. Kindly complete that form as we move towards the end of the symposium. And of course, obviously, the time is not on our side, so if you can afford to write your question as opposed to using a microphone, that will also help us save a bit of time. So we are going for a second round of questions, and if time allows, we can have a third one, but our target is to finish by 11:30, because beyond that, it ceases to be a breakfast engagement. Okay, so I'll start here. There's a question we carried forward from the previous session, and then the rest of the people who have questions, I've seen a hand there. Okay, we'll come over to you.
Thank you. My name's Ntege Kevin from BRAC. And my issue is on the ID with the mobile money agents. I'm thinking this will bring issues of data protection and the risk of identity theft, since now they have my mobile number and NIN. So the suggestion would be that when I'm prompted to put in, before I'm prompted to put in my PIN, I myself, I put in my NIN, as opposed to giving my NIN or copy of my ID to the agent. Thank you.
Thank you, Titi, for your insightful presentation. I'm going to ask, my questions will be 4, and then I'll also make some comments. Some of them will be, largely points of information.
Can you kindly condense them to 2 because of time? Please, kindly. Time is not our best ally.
I don't know,
Thank
maybe
you.
the others are all right. Okay. So one will be on credit, the other will be on FX and deposits, and then one on outlook. Let me see what to condense. I think the first one on credit, if you could just highlight, I know you mentioned something on restructures and how in courts we are still not yet out of the hangover on account of some of those restructures from a credit risk perspective. If you could highlight, please, what percentage of restructures are outstanding as of today, but also maybe more importantly, which sectors you see as struggling the most from the restructures. I will leave out the question on structure challenges and credit risk, but just maybe briefly comment that there is possibilities of areas where we can work together, especially on things like guarantees, etc., to improve the credit risk appetite. On FX, my question will be, with a number of people have highlighted the trend on our reserves. I'm just wondering, the daily reserve purchase program, it now seems not to be a daily reserve program. It's rather sporadic. But from where we sit as a market, we don't see any conditions, once in a while, but largely there are no conditions that are really warranting Bank of Uganda to stay out of the market, because 2 to 3 or 4 million a day is not something that this market cannot take. If you could make a comment on that, I know it may not be fair on you, but maybe you can carry that message if you can't comment, because we think that as these reserves, trend downwards, there is an opportunity that is being missed, by consistently being in the market. The question on deposits is twofold. One, I wonder whether you have some insights on, because the structure of the deposits is changing. We're seeing a lot more time deposits coming in. That could be speaking to even, change in behavior of expectations of depositors. But generally, deposits growth has been anemic. And possibly that's why you're seeing time deposits coming up, with financial institutions, competing for these deposits on a time basis. But it has a long-term impact in terms of the shift in cost of the deposit base, and potentially the impact on profitability of financial institutions. I wonder whether you could provide some insights on, the slow deposit growth rate. The last one is, if you could please highlight, your top 2 risks in terms of the sector, so that we can leave here knowing also, where we could potentially work together or put more effort as markets players. So that's as far as questions is concerned.
Thank you so much.
Just some
Kindly,
2 or 3 comments. The first one, he mentioned the trend on FX balance sheets. I just wanted to highlight that from where we sit, a number of corporate clients are consistently converting their balance sheets from foreign currency to local currency. I think that's something that we've observed, and it tends to come after different episodes of FX weakness. So that could explain why. Let me leave the other comments. We'll have them on the sidelines.
Thank you so much. Thank you. Titi was enjoying your feedback while you were submitting.
Thank you. Thank you very much, Dr. Titi and team, for the insightful submissions. Now, two from me. One is about the credit quality, asset quality, where the NPL ratios were noted to have remained relatively low. On slide, I think, number 8. Mine there is simple. Could you, if you could kindly comment on the extent to which this behavior is being informed by the level of write-offs, you know, because it could look like the portfolios are cleaning up when in fact the reverse is true. Then the second one is about the new capital requirement. I have struggled a little to appreciate the mechanics that inform, particularly the number. And so I'm just here wondering, and I need to be helped. Could it be that the number 150 was informed by our expectations around the impact of the COVID deferrals? If you could make a comment on that, I would be happy. Thank you.
Thank you. Let's have our next one.
Yeah, so thanks for the presentation, Dr. Tumboine. I'm Sulaba from South Africa. So 3 things. So one, if the bank's exposure to government securities is going down, and credit is underperforming, based on expectations, where exactly is that margin reduction in exposure to government securities due to the market? So exactly where is that money going? Is it being traded overseas? Is that money being traded in the treasury departments here and there, or is it sitting in the bank's reserves? And then number 2, could you give me a clear idea of the relationship between the movements in the cost-to-income ratios of the banks vis-a-vis the profitability ratios for the first quarter of this year? What does that relationship tell you about the quote of earnings in the banking industry? And then 3, could you give an idea of how stringent the AML regime is going to be going forward? Is it going to be like the one in Kenya where banks are fined $500,000 shillings and life goes on? It's going to be like in TZ back in Magufuli days where one bank was fined $50 million for one MLSFT violation, and it went to the red in 12 months. Thank you.
Thank you. We'll have 2 more and close this round of questions.
Yes, morning. Thanks for the presentation. My name is Ali Twaha from New Vision. Let me just summarize. I had something on FX reserves. I think we've had a bit of questions on that. Just something I observed over April when the banks are releasing their numbers. And there's a bank, let me not mention the name, which had a share capital of 104 billion. But when you look at the large loan exposures, it grew about to 122 billion, which I think was contrary to the limit on credit concentration and large exposure regulations that we have. I'm just wondering if there's anybody who slept on the job that you could share with us what happened. You did highlight here that some banks gave lending to government, but maybe they didn't. The government is not paying some of the money. But basically, I just wanted to know whether Bank of Uganda, took any actions over this breach of rules by the bank. The second is on mobile money. The 1 billion cap that, rather 1 million cap on withdrawal that the central bank has put in place. I mean, there are several, theories coming up in the market. What if I withdraw 500K from this one and then I go and withdraw the other 500 from the other one? I mean, how are you dealing with those issues that are coming up? Thank you.
Thank you so much. We will have the very last one, but just to clarify that Bank of Uganda has never slept on the job and does not intend to sleep on the job. The very last one for this session.
Thank you so much. Thanks, Dr. Titi, for the wonderful presentation. My name is Dr. Bill Nketo, the Dean Faculty of Business and Management at Victoria University. I just want to be a little basic, just to, maybe make us think a little more. I'm still not convinced that the speculation during elections can be dismissed to affecting the performance of the financial sector. I think it's something that we need to give deeper thought and probably probe a little more to alienate a few fears and probably to better anticipate the after effects. And also, again, an equally other teaser is, I just feel the withholding on cash, I think, is explaining the boom in the real estate. And what is it that we can do about that? Because I'm afraid the census that we hope to rely on, the very people who are withholding on the money may not have the integrity to explain everything that is leading to the performance of the real estate. So the likelihood is high that we may not get the actual answers and the issues may still remain. And that means there is a lot of uncertainty that comes as a result. Then the being over-reliance on the imports, probably something I want to comment is probably more stakeholder engagement. I just feel with the basics that we've been talking about time and again, value addition, so you feel the Minister of Agriculture could come through here to ensure that probably the farmers can add value. And that means once there is proper value that is added to those products, more can be exported because they can now be reserved a little more, and that probably will help to boost what is it that they are doing. Ministry of Trade, what is it that they are doing? Probably we need to find out the stages at which we are. Probably there is some level of consultation that is going on, but probably it's not coming out clearly during the presentations. Thank you so much.
Thank you so much. Victoria University will now invite the technical team headed by Titi to respond.
Okay. First to my colleague from Victoria University, if I recall correctly, I did not dismiss the impact of elections on the financial sector. I merely said the conditions, circumstances that enabled the twin peaks in 2011 and in 2016, those conditions are hardly as prominent or pervasive as they will be in 2026. So the likelihood is low. In other words, there's a non-zero probability it can happen again. But when you look at the conditions that pertained then, I'll give an example. 2011, we had just begun inflation targeting. Because I think around 2011, 2012 is the first time we started using issuance of government bonds to finance the deficit. Before that, it was purely for monetary policy. So you had a slight changing setup which led to those twin peaks. In 2016, I don't know if we should talk about this one in public, but anyway, in 2016, there were certain unique circumstances that led to that twin peak event. Now, can they be replicated in 2026? And my contention is no. We look at where we are in terms of GDP, we look at our growth rates, look at the inflation, look at where the exchange rate was. By the way, during those both periods, there was a consistent argument that our exchange rate was overvalued at that time. Now it's closer to what we think the true valuation should be. So the likelihood for those twin peaks is minimal. Now, stringency of AML requirements. Like I said, for the gentleman who asked this question, if you look at what the Anti-Money Laundering Act regulations and the amendments thereto, the rules are actually, the penalties are going to be, I would say, out of this world. And I hope they don't change my KPIs and make penalties, one of them, because I think I've always hit them. I'll hit my target for the year in the first quarter. The 150 billion. The original figures actually were much higher than 150 billion. The 150 billion was actually informed by, there's actually a proper whole mathematical process that went through it. We looked at past GDP growth rates. We looked at the exchange rate, depreciation of the local unit against the US dollar over the period. We also looked at the increasing impact of technology. So, for example, the last time before 2022, the last time there'd been a capital increment was 2010. You look at the extent to which banks relied on technology in 2010 to provide services and 2022. Take into consideration the growth rates or the rate at which fraud in bank technologies has become prominent around the world, and use that as a proxy for assume the same rate will be achieved in Uganda. And that's how we arrived at that, especially for the bigger financial institutions, an almost 600% increment from 25 to 150. For the CIs, which moved from 1 billion to 25, and you say that, wait a minute, that's 2,500% increment. For the CIs, because of the nature of the customer base they have, getting them up, and the fact that these, if those customer base moved to more and more technology platforms to provide the service, those firms, because of their size, and despite having a wide reach, are less likely to deal with the consequences of losses, even though their ticket sizes tend to be on average significantly smaller. So there was a whole formula around how that figure was arrived at. Of course, then subsequently, as if to give us further impetus, then COVID happened, and now we had to sit down and say, okay, if we get out of COVID, if banks are allowed, for lack of a better word, to massage the value of their loans, massage the value of the assets over this period, what's going to be the knock-on effect? What kind of money does the bank need to be holding that when these assets subsequently either deteriorate or fail, their ability to hold them, to cover the losses? Because there were some businesses, yes, even if they were not struggling before COVID. But after COVID, maybe perhaps that business model has become obsolete. Now, yes, you restructured them before. They were a good customer, but because the environment changed, they're no longer as, that business model maybe perhaps is defunct. So, but you who has lent to them, at the time you lent to them, the business model made sense. Something has happened, it no longer makes sense, but now you're coming out of it. But remember, you put customers' money at stake. So there was a whole new adjustment to that figure, and that's how we arrived at the figure that we did. There was an issue, I think I'll let the others answer them. I'll ask Robert and Huntington to address the other questions.
I think there was a question about whether the trend in NPLs is due to write-offs. I think one needs to understand what NPLs are. If you look at the Bank of Uganda has a credit classification regulation, which most of the people in this room are familiar with. So for commercial banks, for example, if you haven't paid, if a customer is in arrears, say by 90 days, then the bank must start recognizing that as a potential bad loan and putting aside capital for it, and then write it off after 1 year. But I think Dr. Titi explained this point very well in his presentation, that despite the risks we are seeing, the NPL ratio has remained stable over the last 1 year. I think this is the main point, and the question then becomes, is this mainly due to write-offs? As he explained, it partly reflects the fact that banks are now more prudent in their risk management by setting aside adequate provisions for expected credit losses. And this is across the spectrum of all the loans that are in arrears. So it's not just because of write-offs, but also because of the provisioning for loans which are in arrears but are not yet written off. The other aspects about loans that are caught up in the court system and so on, I think he addressed that. There was also a very unique question about the relationship between the cost-to-income ratio for banks and profitability. Of course, the relationship here is obvious. If a bank's cost-to-income ratio is high, there is a very high probability that its profitability is also very what? Very low, okay? But here I want to give credit to banks because on aggregate, the cost-to-income ratio for banks has improved over the last 10 years. About 10 years ago, the aggregate was about 91%. As of March, it had gone down to about 72%. And I think this talks to the initiatives that banks have implemented, including the adoption of agent banking, adoption of digital channels for customers, for lending. I mean, I haven't been to my bank physically for the last 5 years. Every time I ask for something, they show me how I can do it online. So the challenge is how to deepen the uptake of these, the unique products that banks are doing. But having said that, of course, everything is subject to what they call the bell curve distribution. You have banks whose cost-to-income ratio is very good. I think the best banks' cost-to-income ratio is about 60%. And then you have banks whose ratio is more than 100%. So the challenge then is how to make sure that all this goes through. But having said that, there are also other operational issues like fraud, which is very high in some banks, but also the main driver or determinant of profitability in our sector remains non-performing what? Loans. And I think this was touched on in other presentations. So let me stop here.
My interest, I think, is engaging Alan a little bit more because he made certain proposals on possibilities of working together. The central bank with the bankers association on how to reduce credit risk through guarantees, and so probably we shall have an engagement after here. And new vision. There's a question you asked. I don't quite remember what your concern was. Twaha, can you come again on your question? The first question. No, not mobile money, something else.
It's the one on capital. I could be wrong, but I noticed the share capital of the bank was 104 billion. But when I look at the large loan exposures, it was 122 billion. So in my way of interpreting it, I thought the bank sort of, breached some of the regulations on limit on credit concentration and large loan exposures to 005. That's just what I wanted to know, whether it was a breach or it's something you handled. And thank you.
The exposures are computed as a percentage of total capital. And I think your focus here is on an item of core capital. You said share capital was 104 billion. Did you take trouble to find out how much the total was, total capital? The total core capital was, and then the total capital of the institution? Unlikely. No, it's unlikely. Okay, we can have a bilateral. Thank you. Oh, sorry. Albert is here.
Mr. Ntege was the first. Quickly, the licensed institutions or PSPs and the agents will be entirely responsible for customer data. And I think your proposal is very welcome. Some of the discussions with those payment service providers. And of course, as someone puts in his PIN number, then request for the national ID, I think is a very welcome proposal. And that's what I'm going to take it up, so that it is a way of protecting someone's customer details and information. Then Mr. Twaka, Bank of Uganda is very cognizant of the fact that some individuals will be trying to circumvent the directive in terms of withdrawing smaller denominated amount that doesn't hit the 1 million mark. And some behavioral analysis, I'm sure, can be done on that part to see whether they are legitimately doing this to, this is a fraud, or it is someone genuinely just withdrawing that money. And with the behavior analysis, we'll be able to see and capture this. And we are having internal discussions around those issues where people are going to try to do such bad behavior. Thank you very much. I hope I've cleared you.
Yes. There was something Alan spoke about, a daily forex reserve build-up or purchase program. I think Bank of Uganda's policy is that when we're purchasing foreign currency for reserves, we do it in such a way that we cause as minimal as possible disruption to the market. So if we hit a bank in the IFEM and you're pricing outside the range everyone else is trading the market, of course we won't buy. So it's not that it's a daily program, but we have instructions that, and I think the presentation on research, when the person comes up and they're talking about the research presentation, we'll talk about it, is that we purchase as long as it's within range and someone is offering, we're just like any other market participant. We'll take it if you have to offer it, but the offer must be within the range in the market. Someone here is asking about, some people have been reported to be lured into cryptocurrency. A comment on whether this is yet to be recognized. I think, first of all, correction. There's no such thing as cryptocurrency. What people are actually trading are tokens. The right to something is a token. It's not a currency. Because the currency, by definition, is a unit of exchange, medium of exchange, unit of account, and it has got some unique characteristics for something to be qualified to be called a currency. That's one, which crypto doesn't have. Two, the government of Uganda and the Bank of Uganda, that's Minister of Finance and Bank of Uganda, have been very clear. These are unregulated. And if someone chooses to do so, they do so at their own risk. If you can be lured into something which has no protection, I think maybe perhaps you don't deserve protection. No, seriously. It's been repeated over and over again. You did this at your own risk. And I think there's a limit where we can go as regulators. If you choose to do, we've warned you, we've told you, when you deal with that, we don't have anything to do with it. So, if people get lured in or out, that's their business. I don't know if there was another question that we had left out, because I think we have some other presentations to make.
Sure, you've competently responded to all the questions that were raised, and one, thank you so much for that response. One, thank Hannington and Robert for responding to the questions. Ladies and gentlemen, I promised that we should be out of here by 11:30. I've fallen short by some minutes, my apologies. But just to emphasize that a copy of the report is on the Bank of Uganda website. So in case you want that document, it's there. But also you registered your emails, and you can get in touch in case you're unable to find it on the website, and we advise you accordingly. And then lastly, to remind you, please, the registration forms, if you have filled it, just put it on top of the table. Bank of Uganda will collect them at the end of the day, together with the evaluation forms. Please do not leave without giving us feedback, because we want to serve you better. Ladies and gentlemen, please allow me invite Rita from the Communications Department to come and give a vote of thanks. You're welcome, Rita.
Thank you, Robert Owagonza. Good morning, everyone. My name is Rita Ampire Biruganda Nwagaba. I'll stop there for now. I'm from the Communications Department. And on my behalf, and on behalf of Communications Department, on behalf of Supervision Directorate, that Dr. Titi and the two gentlemen next to him head, and on behalf of the entire Bank of Uganda, I'd like to say thank you very, very much for honoring our invitation and for choosing to stay even when we started a little later than we had planned to. We're grateful that you have chosen to stick around. Thank you for the participation. To our online audience, we apologize for any glitches. There is a general internet problem. I think there's a submarine that stole our cable lines. But nonetheless, we apologize if we were not very clear. And as Andrew highlighted in his opening remarks, we had two key items to achieve today. Number one was to explain Bank of Uganda's financial stability mandate. I hope Dr. Titi and the two gentlemen next to him have delivered on that. If not, kindly put that in the evaluation form. I will make sure, personally, make sure that they get the evaluation that you've given them. But number two, we wanted to get genuine feedback from you. So thank you for participating. Thank you for the questions. And thank you for filling in the evaluation forms. I am sure you have done so. And finally, there's a gentleman that asked about Bank of Uganda's increment in the minimum capital requirement. So the other day I was listening to the traders when they met with His Excellency about the IFRIS, and one of them was doing the math for him. And he said that in 2006, when they introduced the threshold of 150, the exchange rate was 1,040 to the dollar. And today, the exchange rate is north of 3,700. I am not implying anything. I'm just saying that when the capital requirement was initiated back in the day, the exchange rate was about 1,000, and the inflation was somewhere there. And now we are north of 3,000. I'm just saying. I'm just saying. So with that said, ladies and gentlemen, thank you very much. Thank you to the team from Bank of Uganda. We're grateful to you. If your question was not answered, the team is still here. There's a table over there. They're mostly from Bank of Uganda. There's a table there. We have Pamela. We have Julie. So there's a team around here from Bank of Uganda. Kindly get to them. You can have a one-on-one. Your questions will be attended to. Again, thank you very much. Unfortunately, I didn't budget for lunch. Next time I'll do better, so I must let you go before midday because I have no lunch to serve. Thank you very much, ladies and gentlemen. Have a good morning and a lovely week ahead.
Rita Ampire Biruganda Nwagaba. I got the order right. Thank you so much, ladies and gentlemen. That's the end. Once again, Robert Owagonza, it's been a pleasure being your moderator today.